Two people, same age, same job, same salary, same $50,000 saved. 20 years from now, one of them will have almost 10 times more money than the other. And it won't be for the reason you think. Meet Ethan and Lucas. Both are 28. Both earn $65,000 a year. Both just hit the same milestone, $50,000 saved. Ethan believes real estate is the proven path to wealth, something tangible, something he can point to. Lucas believes the best investment is the one that asks nothing of him, something that just grows quietly while he gets on with his life. We're not tracking every dollar. We're following two entire strategies, 20 years apart, because where they land is nothing like what most people would guess. Ethan puts his $50,000 down on a $250,000 rental home, financed with a 30-year mortgage at 7%, about $1,330 a month. Within weeks, he's got a tenant paying $1,800. After the mortgage, that's roughly $470 left over every month. Feels almost too easy. Lucas puts his $50,000 into a total stock market index fund. No leverage, no tenants, no repairs. He automates $200 a month into it and closes the app. Day one, there's no contest. Ethan owns a house. Lucas owns a confirmation email. One feels real. The other feels invisible. But investing was never about what feels impressive. It's about what actually builds wealth. Those aren't the same thing. 3 years in, Ethan's collected about $64,800 in rent against $47,880 in mortgage payments, nearly $17,000 ahead on paper. Then the real bills show up. Taxes, insurance, maintenance, a vacant month, a new tenant to find. Add his own unpaid hours managing it himself, and that $17,000 shrinks to a few $1,000s. Lucas's $50,000 plus $200 a month at the market's long-run 10% average has grown to about $76,000. He hasn't taken a single tenant phone call. But Ethan has one thing Lucas has replicate: leverage. His property's now worth $275,000 to $280,000, and his equity sits around $80,000 to $85,000. Real wealth, built by controlling a $250,000 asset with $50,000 of his own money.
Here's the part nobody mentions, though. Rent isn't profit. Rent is where the story begins. Budget a month a year for vacancy. Turnover costs every time a tenant leaves. Maintenance runs 1% to 2% of the property's value annually, $2,500 to $5,000 on this house. And the big-ticket items, roofs, water heaters, furnaces, aren't if, they're when. One repair can erase months of profit in a single invoice. Year 5. 3 tenants have come and gone. The roof needed replacing. A plumbing emergency showed up from nowhere. Rents climbed to $1,950, but so have the costs. Ethan's actual cash-on-cash return settles around 3% to 5%. Respectable. Nowhere near the 15–20% people throw around online. Lucas's year 5 looks like year 1, just bigger. No strategy changes, just $200 a month on autopilot. Year 7. Lucas is at roughly $120,000, and something shifts. His annual growth is now bigger than many of his own contributions. Compounding doesn't ramp up gradually. It sits quiet for years, then starts producing gains on top of gains. Year 10. Ethan's property is worth $335,000 to $370,000, with the mortgage down to about $172,000, leaving him $165,000 to $200,000 in equity, after roughly $30,000 spent on taxes, insurance, maintenance, and vacancy over the decade.
Lucas has put in about $74,000 of his own money total. His account is worth $170,000 to $180,000. Everything above his contributions came purely from the market compounding. They're nearly tied. Ethan might even be slightly ahead, but he got here carrying hundreds of thousands in debt, his entire investment locked into one house in one neighborhood,
after hundreds of hours of hands-on work. Lucas got here owning slices of thousands of companies, able to sell in seconds, having done nothing but click confirm once a month. Year 20. Ethan's property is worth around $500,000. His equity has grown to approximately $385,000, plus roughly $120,000 in net cash flow banked over the 2 decades after every expense. Lucas's $50,000 plus 20 years of $200 a month, about $98,000 of his own money, has compounded to approximately $518,000. More than $420,000 of that came from growth alone. No debt, no tenants, no repair bills, ever.
Added up, equity plus 20 years of banked cash flow, and Ethan's total wealth lands around $505,000. Lucas's index fund sits at approximately $518,000. Almost dead even. 10 times the debt, hundreds of hours of hands-on work, and a portfolio tied to one house in one neighborhood, to land in almost the exact same place as someone who clicked confirm once a month and never thought about it again. Ethan built his wealth through leverage. Lucas built his through compounding. Ethan took on concentration risk, everything tied to one house, one market. Lucas took on volatility, the kind that can drop a portfolio 30–40% in weeks, the way it did in 2008 and again in 2020. And if you're thinking, so stocks just win? That's not fair either. Stocks carry real risk. It's just easier to ignore with no building reminding you of it. A $150,000 portfolio might throw off $250 a month in dividends, nowhere near replacing an income. And leverage is something the stock market simply can't replicate. Lucas's $50,000 bought $50,000 of investments. Ethan's $50,000 controlled a $250,000 asset.